All right, today we're going to dig into something really cool. It's a tool designed to answer a super tough question with cold, hard data. Is the CEO actually any good? We're taking a look at the CEO-Rater report card.
I mean, this is the big question, right? It's something that keeps investors up at night and probably comes up in a lot of company town halls. So how do you get past the gut feelings, the media spin, and find a real solid answer?
For years, the answer has just been kind of fuzzy. A mix of media hype and a quick glance at the stock chart. But we all know a rising market can make anyone look like a genius. A climbing stock price doesn't automatically mean the CEO is steering the ship perfectly.
Well, what if you could strip all that subjectivity away? That's exactly the problem a platform called CEORater was built to solve. It's all about creating a purely data-driven report card for the leaders of the world's biggest companies. So how in the world do they do it? Well, it all starts with one crystal clear core principle. And this is it. This is the foundation of the entire system. A CEO's main job isn't just to make money. It's to beat the market. That outperformance, what investors call alpha, that's everything. So it all boils down to this simple question. Did the CEO's performance actually clear the bar set by the market itself? This idea is the first major building block of their entire rating system. Let's see how they measure it. And that brings us to the first key metric, the alpha score. This is all about measuring that market outperformance we were just talking about. Okay, first thing we need to get our heads around is TSR, which stands for Total Shareholder Return. Think of it as the complete picture of how an investment did. It's not just the stock price going up, it also includes any dividends that were paid out while that CEO is in charge. But here's the key. A CEO's TSR isn't just looked at in a vacuum. Nope, it's compared directly against a benchmark. In this case, the NASDAQ 100 index, which is often tracked by the ETF with a ticker QQQ. If you see a positive number here, it means the CEO didn't just get lucky with a rising market. It means they actively created more value than the market itself. So how does all that turn into a simple score? Well, it's a pretty clever three-step process. First, they rank a CEO's total outperformance against all their peers. Second, they do the same thing for the annualized outperformance. And finally, they just average those two rankings to get one single score from 0 to 100. And boom, that's the alpha score. But look, great performance is only half the story, right? The other half is, yeah, but what did it cost us? And that brings us to the second pillar, the comp score, which is all about rating paycheck efficiency. The comp score is a simple A to F letter grade, just like in school. But don't let that simplicity fool you. It's measuring something incredibly important, how efficient that CEO's pay really is. In other words, it's asking this. If you have two CEOs and they both deliver a 20% return, but one of them was paid 10 times more than the other, were they really equally valuable? The comp score says absolutely not. It rewards the leaders who deliver amazing results without an insane price tag for shareholders. Okay, so we've got performance measured by the alpha score, and we have efficiency measured by the comp score. Now let's put them together for the grand finale, the final CEORater score. So just think of it like this. You've got these two big pillars holding everything up. On one side, you've got the alpha score. That's pure market-beating performance. And on the other side, you've got the comp score, which is all about how cost-effective that performance was. So how are they actually combined? Well, the final score is a weighted average. The alpha score, the performance, makes up a hefty 60% of the final grade. The comp score, efficiency, accounts for the other 40%. This weighting really reflects that core principle we talked about. Performance is number one, but efficiency is still critically important. Now, to make the math work, you gotta turn those letter grades from the comp score into numbers. So an A becomes a 95, a B is an 85, a C is a 75, and so on down the line. Let's use a real-world example to make this super clear. Tim Cook of Apple. Check this out. His alpha score is a very, very strong 83, but his comp score is a C. So when you run that through the 60-40 weighted formula, you get a final CEORater score of 80. That's still really strong, but you can see how that C for compensation pulled his amazing performance score down just a little bit. Okay, so now we understand the score, which is great, but how can you actually get your hands on this data and, do something with it? The data basically comes in two flavors. You've got the UI format, which is clean, easy for us humans to read, But for all you folks who want to build your own tools or do some deep analysis, there's the raw format. It gives you pure, unformatted numbers, which are perfect for plugging into spreadsheets or your own applications. And you can access all this stuff through a public API. This is huge. It means you can programmatically pull the entire list of rated companies, you can get a super deep dive on one specific stock, or even build a search function right into your own software. And that's the real magic here. This isn't just a static rating you look at once. It's a dynamic tool for investors, for researchers, for developers. It really empowers people to use this objective data in new and really creative ways. Which, of course, leaves us with one final big question, and this one's for you. Now that you've got the formula, now that you can look beyond the headlines and actually measure a CEO's true value, who are you investing in?